we are seeing a policy divergence between the Federal Reserve, the BOJ, the PBOC as well. What are you watching closely to sort of gauge where the potential opportunities could be?
Yes, absolutely. I think the reason we like China the most is because it has just gone through a legitimate and pretty deep recession that it's coming out of, right? And the process of exiting that recession recovery is going to be kind of bumpy because of external concerns such as what you've been covering all morning, and because of lingering COVID control policies, risks with that. So it's going to be a bumpy road, but I think China has turned a corner, and I think that's the key opportunity for us in the second half, when we're likely to see a global volatility still elevated.
Can you also play the divergence between the Federal Reserve and the BOJ? We have seen a very weak yen, but even weak yen beneficiaries haven't done that well.
This is true, right? I mean, the Japanese equities, that's supposed to be the weak yen beneficiary, but no. At the moment, this has all been driven by movements in the U.S. yield, and the BOJ has done all they can to keep its yield curve control policy, in place. So I think the question really is, one, will Kuroda be able to maintain his policy? And it sounds like he wants to. And two, when will U.S. yields roll over and begin to come down? And I think that's obviously a function of inflation as well. So there's a lot of moving parts here.
One of those moving parts is the recovery in China. You call it meaningful. Does that mean we could continue to see, on top of the policy divergence between the PBOC and much of the rest of the world, that opportunities are emerging in China?
Yes, I think so. Because first of all, the COVID pandemic control policies is likely to become a little bit more measured and more selective. They get smarter in implementing these partial lockdowns. So I think the Shanghai style of lockdowns is it's going to become less likely. But if we have another wave before the Party Congress, then we might see more partial restrictions. And then after the Party Congress, I think the political imperative to lock down will weaken, and the policy is likely to have more flexibility. So that's on the largest domestic risk to me. And for the external risk, I think it more depends on whether the U.S. goes into recession. And I actually think that even if it does, it's not going to be a very deep one. And so in that in that general scheme, I think that Chinese equities can be more resilient and continue to price in recovery. At the moment, the pent-up demand is not fully released. We made some progress in terms of tech regulation, but that's not, the valuations there. Basically, we only recovered about 1/10 of what was lost. I think there's quite a long way to go in this recovery road.
Yeah, Ken, we're seeing a lot of repricing across the board when it comes to sovereigns. We're just seeing now the Australian 10-year yield rising above 4% for the first time since 2014. With the Treasury's action overnight, the biggest 2 days for Treasury since 1987, is there a sense that you're getting a lot of questions asked really across the curve in terms of where that neutral rate is going to end up, and if we're going to have to see clearly restrictive tightening measures now from central banks, not just getting to neutral?
Yeah, well, actually, I think I want to talk a little bit about inflation first, right? I mean, we did see that the goods inflation continued to roll over, right? We peaked at some 12%. Core goods CPI in the U.S. peaked at 12% in February, and now we're about 8.5%. So that's happening. What's happening in services inflation, the continuous climb, is surprising markets, but I think it's the repeat of what goods inflation did about 6 months ago, right? So I think the inflation cycle moves in this fashion each time, and I think it's basically a matter of time that before we see the downdraft from demand bring prices down. So I think that's probably still going to happen towards the later part of this year. At the moment, we're probably at peak fear, peak hawkishness in terms of the Fed. But I think that this week they're still going to go with 50 basis points, but they're likely to maintain a fairly firm language leverage while they do that.
So does it make sense then to have these recession hedges now being raised by traders? I believe at the fastest pace since 2020, we're talking about those defensive trades, long dollar calls, downside stock protection, given that, of course, this very aggressive tightening could, as you mentioned, now lead to perhaps a slowdown later next year and perhaps even rate cuts in 2024.
Well, actually, I think rate cuts might come earlier. Possibly by late, by late 23, we could be seeing that being priced in more aggressively into markets. But at this moment, I think we should be very careful, right? Because if you're continue to pile on to long dollar, pile on to the short equity trade, you're prone to get squeezed, right? So investors who do that should be very careful with those kind of trades. But ultimately, I think this is still going to be a more positive market for bonds before it becomes one for equities, right? Because all it takes for bonds for risk-free yields, treasury yields to come back down, I think it's for inflation to roll over and for inflation expectations to become more anchored. What it takes for equities to find a bottom, I think we need to see signs of a demand bottom, which might come a bit later.